Good morning and welcome to our financial institutions year-end accounting and auditing update. We appreciate you all joining us today. Just some housekeeping to start off to make sure everyone gets their CPE. CPE is offered at 2 hours for every 50 minutes for accounting field of study. There's no partial CPE credit offered for this event. Please log in with your unique link, the link that was sent to you, and stay logged in the entire webinar to ensure you receive CPE credit. Participants must answer 80% of poll questions to receive CPE credit, and there are 8 in total. Certificates will be distributed via email within 7 days of the virtual event, and email certificates will be delivered from Carr, and Ingram, and the email that you see there. And questions about the certification process can be sent to marketing@cricpe.com. Note the PDF handouts or presentation slides are accessible for download through Zoom chat. And just a note before we get into it, the poll questions will come. We have 8 of those, as mentioned, and they'll come up, but they will not be substantive. We're not trying to obtain any information, or they're not technical in nature, and we won't wait for the poll and those type of things. They will come up and there will be very general questions. Maybe it might say, "Are you there?" And you just need to click it and show that you're present, and we'll keep on. So we'll pause for a second when we're presenting for the poll question, but then we'll move on pretty quickly and you'll still have time to answer your poll. So with that, let me see. Okay. All right. So our presenters today include Heather Barber. Heather's a partner in our Birmingham office who specializes in serving financial institutions. Chris Kane will also be presenting today, and Chris is a partner also in our Birmingham office, and he also focuses in serving our financial institution clients from Birmingham. Hillary Collier will be on today. She's here in Atlanta with me, and she works in our financial institution practice on a routine basis. Rob DeMombrin heads up our banking practice in the Nashville office. He will be presenting today on ESG. And myself, I am serving as the moderator, and I'll also present. I'll start us off and I will wrap us up in this process. So today we're going to cover 6 areas: loan modifications, debt securities. We'll have a FASB update. We'll really cover what the FASB has been up to this year and what's on the horizon. Rob will cover environmental, social, and governance, also known as ESG. Heather will cover auditing estimates and using the work of company specialists, as that is on the horizon for years ended 12/31/23. And I will close us out with PCAOB SEC update. So loan modifications. So I know everybody's heard that TDRs have gone away. TDR accounting will go away as of 1/1. And so I think everybody was relieved. There was a lot of discussion about that in relation to CECL. And we aren't covering CECL today. I guess from our perspective, most that ship has sailed to some degree, and most everybody is ready to go 1/1. So we didn't include a CECL segment. So, but nonetheless, subsequent to the issuance of the initial CECL guidance, ASU 2022-02 was issued regarding troubled debt restructurings and vintage disclosures. It eliminates TDR accounting as we know it today. It does require new disclosures for certain loan refinancings and restructurings when the borrower is experiencing financial difficulty. And I will draw a distinction here in this between accounting and disclosure. There's changes in accounting for loan modifications, but there's also disclosure requirements, and the disclosure requirements are slightly different than the accounting. So just be aware of that. I'll try to point it out as we go. The ASU 2022-02 also requires public business entities to include current periodic gross write-offs in their vintage disclosure tables. So this guidance was issued in March of this year. For CECL adopters, it's effective for periods beginning after December 31, 2022. So for the CECL adopters who've already adopted, either early adopted CECL or adopted as part of the 2011-20 exercise, this guidance is applicable as of 1/1. It also provided for the ability to early adopt. I'm not aware, none of our clients have early adopted in any, regardless of whether they've already adopted CECL or not. And I'm not aware of, when I've talked to my colleagues, others, not aware of a whole lot of folks that are out there early adopting, but there could be some that we're just not aware of. For others that hadn't adopted CECL yet, it's effective upon adoption of CECL. Again, it would have been applicable if you early adopted, but nonetheless, 1/1 is pretty much the date for everybody, and that's where we think the industry is. So, and just as an aside, this does not impact the accounting guidance for the borrower. So this is solely from the financial institution's perspective and has no bearing on how the borrower accounts for the debt on their side. Okay. Just checking our Q&A. Okay, so this guidance, so with the adoption of this, it basically takes you back to ASC 310-20 for loan mods. And that requires that all modifications and refinancing, including those with borrowers experiencing financial difficulty. So it's all modifications and refinancings from an accounting perspective are subject to this guidance. They may not need disclosure, but from an accounting perspective, it relates to all modifications. It does amend the insignificant pay delay guidance, and it limits consideration of previous modifications. Under the current guidance, it's any modification in the history, if you will, of the loan. It goes back to the beginning of time. In this instance, you only consider the previous 12 months from a restructuring perspective. So there's really two questions to start off with from an accounting perspective, and that is it a new loan or is it not a new loan? And so these first couple of bullets are the guidance around whether or not it's considered a new loan. So if the terms of the new loan, including its interest rate, are at least as favorable to the lender as the terms with a customer with similar collection risks, that would make it a new loan. So if you're restructuring or refinancing and the terms are similar to someone who's not experiencing financial difficulty or going through a refinance or restructuring, then it is likely a new loan. And otherwise, the modification to the terms of the loan are minor. So that's the first question. If you conclude that the loan is a new loan, or the restructuring is a new loan, then any unamortized net fees or cost from the original loan and prepayment penalties should be brought through income. So any of those things you hung up on the balance sheet, whether it's net fees, costs, any deferred prepayment penalties, any of that stuff, if it's a new loan, then you would flush those through the income statement, and a new effective interest rate will be determined. So this guidance is if you determine it's a new loan and the loan is being made on substantially the same terms you would do for someone who wasn't going through this a restructuring or refinancing. So if you determine some modification, so it's either a new loan or it's not. If it's not a new loan, that makes it a modification. So if that's the case, the investment in the new loan should include the remaining net investment in the original loan, any additional funds advanced, any additional fees received, and any additional direct origination costs associated with the refinancing or restructuring. So as opposed to if it's a new loan, you wouldn't, if you will, flush the things through the income statement that were already there. You would add to them, and as part of that, you would have to recalculate based on the amortized cost basis and the contractual cash flows. You would have to recalculate the effective interest rate on that debt. So while TDRs go away, this pushes you to ASC 310-20, and it results in some additional accounting considerations that we currently don't don't have under the existing guidance. And with that, there should be a poll question. If you are not seeing a poll question, please let us know in the chat so that we can address it. But you should see something up there now. And I will continue onward. There it is. So I do see it. Hopefully you all see it, so you can get your CPE credit. Highly technical question there. Go with me. All right, so loan modification. So from a disclosure perspective, the new disclosure requirements apply to modifications with borrowers experiencing financial difficulty. So whether it's if you determine it's a modification, so again, it's either a new loan or a modification. If you determine it's a modification, the new disclosure requirements apply to borrowers who are experiencing financial difficulty. Not to all loan modifications, just those experiencing financial difficulty, and that results in a direct change in the timing or amount of contractual cash flows. These are some examples that would include that. Would include principal forgiveness, interest rate reductions, other than insignificant payment delays, term extensions, and a combination of all the above. So those are just some examples of what you would consider regarding the direct change in the timing or amount of contractual cash flows. And this does eliminate the concept of concession that we all use today under the TDR guidance. Okay. And here's some of the disclosures. This is not, it doesn't have a significant level of granularity, but it'll include modifications due to financial difficulty, modifications that defaulted within the previous 12 months, both quantitative and qualitative information, commitments to lend additional funds, and it excludes loans accounted for at fair value. It would not be included in this guidance. So the disclosures from a theoretical perspective are very similar to what we do today. So the more things change, the more they stay the same to some degree here. Okay, and maybe a summary simplification hopefully is from an accounting perspective. So today, to determine if something's a TDR, is the borrower experiencing financial difficulty and has the lender granted a concession? Insignificant delays are typically 3 months, and you consider all past restructurings in this process, and then you would determine the income statement impact. So that's what we're doing today. Under the new guidance, the first question is the modification to a borrower experiencing financial difficulty? Again, these are only modifications. So if you determine it's a new loan, it's a new loan. If you determine it's a modification, the first question is it to a borrower experiencing financial difficulty? Is the modification a direct change in contractual cash flows? Insignificant delays, still considered typically 3 months, and you only consider restructurings over the past 12 months. And then you determine the income statement impact, and that would be accounted for, based on whether the loan is a new loan or a continuation of the prior loan. Okay, so continuing on with loan modifications, a policy statement on prudent commercial real estate loan accommodations and workouts was issued in August of this year, with comments requested by October the 3rd. And so I wanted to cover this briefly. I'll move through this pretty quick, but so there's new CRE guidance out there for commercial banks. It includes risk management elements. It covers classification of loans, regulatory reporting, and other accounting considerations. And I'll go through a few of those here. Financial institutions that implement prudent CRE loan accommodations and workouts will not be subject to criticism for engaging in those efforts. This language is very similar, if not identical, to some of the guidance that was put out during the pandemic. So it's continuing on by saying you're not going to be punished by trying to work with your customers. Also, modified loans to borrowers who can repay on reasonable terms will not automatically be subject to adverse classification solely because the value of the underlying collateral has declined to an amount less than the loan balance. So that's a couple things there. Other items covered include short-term loan accommodations. And again, there's COVID-19 language in there. Accounting changes, it does incorporate CECL. So the previous guidance that was out there had been out there for a while, and it did not include CECL. There were, as we sit now, certain updates related to TDRs that were updates that occurred since 2009. That'll go away as of 1/1. So in the final guidance, it won't include TDRs. It'll include the information we just went over, the loan modification guidance, and it does contemplate that ASU 2002-02 is on the way. From a CRE workout examples, there's some of those in there, and they focus on credit classification, some examples around determination of non-accrual status, and also determination of TDR status. And again, in the final document, those will go away. And we come to another poll question. So with that, the poll question is there. We will advance to the next section, which is debt securities, and Chris Kane is going to present that section.
Yeah, thanks, Doug. Appreciate it. I'm Chris Kane again, a financial institution partner in the Birmingham office. And today I'm going to talk about really one of the hottest topics for financial institutions that is available for sale, debt securities. And one factor to consider now is, with that significant decline in these securities prior to the adoption of CECL, is other than temporary impairment for year-end or OTTI. So the significant decline in the available for sale portfolio of many institutions may be primarily the result of kind of general economic market conditions, and may not be specific information pertaining to an industry or an issuer, but really some factors to consider with regard to OTTI for year-end include the length of time and extent to which the market value has been less than the cost, and the financial condition and near-term prospects of the issuer, and then also the intent and ability of the holder to retain its investment for a period of time sufficient to allow for an anticipated recovery in the market value. So when you think about these factors, really you look at total impairment significance. So in looking at that, you look at kind of what is the magnitude of the current decline. And we see that many institutions use kind of 10% as a general rule of thumb for that evaluation. And then also duration of the loss. And generally institutions kind of here look at greater than 1 year, and then also evidence that the issuer has suspended, interest and or dividends. And then also one factor to consider would be kind of any downgrade in credit ratings of the issuer. So those are things to think about with regard to OTTI. And then also to evaluate further, if we were to kind of look at, on the next slide, the intent and ability to retain the investment for a period of time sufficient to allow for an anticipated recovery in market value. And this can really be challenging because, as we know, the majority of those individual available for sale securities are in a large unrealized loss position. So I think here documentation is really key. And in that documentation would be kind of the long or uncertain time frame for anticipated recovery of the market value. And then I think most importantly here would be near-term liquidity needs. And if those needs need to be satisfied via sales of available for sale securities. And, if that's the case, that could cause the institution to really say it does not have the ability to retain for a period of time sufficient to allow for recovery. So therefore, OTTI is likely. So those are the things to really document at year end and to consider and to really evaluate further with regard to OTTI. So then looking outside of OTTI, and this is probably the biggest topic for discussion and debate is, hey, what about transferring those investments from AFS to HTM, which is kind of on this next slide. And, really looking at that from both a GAAP perspective as well as from a regulatory perspective. So really when we look at this for the clients that I'm involved with, the GAAP capital issue is really significant here. And then from a regulatory perspective, we see that most smaller financial institutions made the accumulated other comprehensive income election to really opt out of AOCI from regulatory capital ratios. So really, when you look at this, it's really kind of GAAP capital, negative tangible equity, and really doesn't have an effect from a regulatory perspective from the GAAP ratios, but could have potential for liquidity implications from FHLB and subordinated debt. So talk to a lot of institutions in this space and really looking at, hey, how about transferring certain securities from AFS to HTM? And, from a regulatory perspective, it's my understanding that FHLB lending is likely not to be an option for institutions with negative GAAP capital there. So some things to think about here are, should the institution transfer available for sale debt securities to HTM, the held to maturity, and what factors to really consider at that point. So we're going to dive into those and, really what is the unrealized loss at the date of transfer. And this does not go away immediately. It's really amortized as a yield adjustment for those securities that are transferred. So, this is an option to explore when moving those AFS to HTM. It does not immediately get rid of that other comprehensive income component of those unrealized losses. From a GAAP capital perspective, it's amortized as a yield adjustment for the securities transfers. So when you look at this further, one question that I've helped a lot of community banks with is what might be good available for sale debt securities, good candidates to evaluate for a transfer from AFS to HTM. And I like to say it's generally those that are most impacted by changes in interest rates. So if you think interest rates are going to increase, those are good candidates for the evaluation. So what I've seen a number of institutions do here, and I've worked with those and assisted with discussions and working with bond accountants, is really to kind of model moving certain available for sale debt securities to held to maturity. So really modeling is the key, and evaluating multiple alternatives and really saying if the institution were to move these securities from AFS debt securities to HTM, what does that look like? And I know the results for one institution that I was involved with after that modeling only had to move about 50% of the securities that they initially thought they wanted to move from AFS to HTM based on those modeling results. So I can't stress enough the importance of modeling, to really work with a bond accountant to really make sure you understand the impact of moving those investments. And then if interest rates were to move, what does that look like? And how does that impact the institution on a go-forward basis? So if you have questions, I know the CRI team is happy to help assist with evaluating that further. So kind of moving on and looking at debt securities on the next slide under CECL, and this would be obviously for our January 1, 2023 CECL adopters. And some really important points here is that this guidance modifies the current OTTI model. And really, if you think about it, one of the most important aspects of that is a use of allowance instead of the direct write-off now. It also removes some criteria regarding kind of the length of time and extent of fair value less than the cost. Also removes some criteria with regard to consideration of post-balance sheet recoveries or declines. And then I think probably the most important bullet point on this slide is that the credit losses are indeed limited to the amount that fair value is less than cost, and that kind of establishes the floor there and cannot do more of a loss than the fair value. So let's look at the kind of the codification on this next slide and what that looks like. And lots of words here. So let's kind of dissect what this slide is telling us and what ASC 326-30-35-10 is saying. So if an entity intends to sell the debt security, that is, they have made that decision, hey, we're going to sell the security, or the threshold is, more likely than not, the institution is going to be required to sell that security before recovery of its amortized cost basis. Any allowance for credit losses shall be written off, and the amortized cost base shall be written down to the debt security's fair value. So, if the decision has been made, then that's the treatment for that. But let's take that a step further and let's kind of talk about what if an entity does not intend to sell that debt security. So in that case, the entity really would need to consider available evidence to assess whether it more likely than not would be required to sell that security before the recovery of its amortized cost basis. So really there would be an evaluation process. So evaluation process of that more likely than not, will we require to sell the security before recovery of its amortized cost basis? So what factors should be considered? And those factors are really outlined in paragraphs 326, 30, 55.1 through 55.2. So let's look at those factors and let's kind of discuss what those look like. So again, here, we like to say documentation is key. So what I envision under the CECL environment is a memo, and this memo would really kind of outline these factors and these bullet points, and then the institution would kind of analyze the most significant ones and then kind of make a determination with regard to more likely than not will be required to sell the security before recovery of its amortized cost basis. So if we were to look at these, the first one, the extent to which the fair value is less than the amortized cost basis, is it in a loss position? Are there certain adverse conditions which are really specific to the security? It may be specific to the industry in which the security or the geography of the security. So really breaking those adverse conditions down into kind of those that are related to the security, those that are related to the industry, and then those that have implications with regard to geography. So then if there have been any changes in the quality of the security's credit enhancement, and then looking at the payment structure of that security, and then any changes in the security's credit ratings, obviously something really to look at and to monitor, and then failure of the issuer to make scheduled principal or interest payments, remaining payment terms, prepayment speeds, clearly looking at the issuer's financial condition, and then the value of any underlying collateral. So those are the things under CECL for debt securities, AFS, what you would need to look like. So on the next slide, we kind of have this debt securities AFS under CECL and a decision tree here. So within this section, I think this is a really important slide So you should star it, mark it as really important, because I think this is something that you can go back and refer to. So let's go through this decision tree and talk about it and really walk through this impairment methodology under CECL. So if you look at the top left-hand portion of the slide, the first question is the fair value of the security less than its amortized cost? And if the answer to that is no, this is really easy. There's no impairment and you're kind of done. So if the answer to that question is yes, then you would go to the next question, kind of question 2, which is, does the institution intend to sell the security? So again, if the answer to that is yes, then you would go here and say, well, any previously recognized allowance for credit losses is written off, and the security's amortized cost basis is written down to fair value through earnings. So that would be the treatment there if the answer to question number 2 is yes. So then if the question, a response to question number 2 is no, then you would go to kind of question 3, which is it more likely than not that the institution will be required to sell the security before recovery of its amortized cost basis? So here, if the answer to that is yes, you would go to that same block and say, well, any previously recognized allowance for credit losses is written off, and the security's amortized cost basis is written down to fair value through earnings. So, but what if that response to question 3 is no? So we're kind of down at that last block there on the left. So that would be saying, hey, if the decline in fair value has resulted from credit loss or other factors, then what you would do is you would recognize an allowance for credit losses by charge to earnings for the credit-related component of the decline in fair value. Again, this would be subject to the fair value floor, and then if you had a non-credit related component, you would recognize in other comprehensive income the non-credit related component of the fair value decline, if any. So again, I think this decision tree is really helpful. It kind of breaks down impairment methodology under CECL for AFS securities, and hopefully will be a resource for you in the future, and something that you can use in kind of a practical way to really look at that. So moving on to, hey, let's look at debt securities, and we're looking at the held to maturity portion of the portfolio. And this is under CECL. So after that, January 1st, 2023, for many folks after adoption. So here, what we're going to be looking at is we're going to be looking at the use of an allowance instead of a direct write-off. So with using an allowance, reversals, would be permitted. And then what does that credit loss evaluation look like? And the best way for me to describe that would be it's very similar to current practice. So also, how might you look at these held to maturity securities and really look at pooling based on similar risk characteristics? You might do that in some methodology that might be somewhat similar to risk within that portfolio, and slice and dice that. So when you look at the HTM portfolio under CECL, one question that I'm getting from a lot of my friends and from bankers and clients is, what amount of allowance am I seeing for those banks that are adopted CECL or about to adopt CECL, and maybe running parallel between CECL and an incurred model? And really what I'm kind of seeing is that banks are evaluating the HTM portion of their portfolio, but generally speaking, the results of that analysis are really small. And Heather and I were working with a client in the last few weeks on this topic, and we really were talking to them about, well, when you kind of quantify that allowance for the HTM portfolio. What does that look like? And in this case, it was less than $5,000. And this was a $1 billion institution. So in talking with those bankers and ones that are really looking at this, it's been my experience that a lot of these amounts are quite small and really just an exercise to kind of go through as part of that process. So those are things to consider as you look at the implementation of CECL January 1. And really kind of the last thing to consider with regard to debt securities as part of this section. So with that, I think we have another polling question. So this one's obviously very simple question. So we're going to give people a few minutes, a few seconds rather, to answer that question. And then we'll move into our next section, which is the Financial Accounting Standards Board update, or the FASB update.
Thank you, Chris. So Chris pointed out the poll question. Hopefully you see it. They just want to know if you're still there, and hopefully you are. And with that, we will move on to the FASB update. And Hillary Collier, who is a partner here in Atlanta, as I mentioned earlier, is going to go through this with us. So Hillary, I'll hand it off to you.
Thanks, Doug. Good morning, everybody. I'm going to cover the FASB update. We attended a few of us attended the AICPA Bank Conference this year, and they had 3 areas that the FASB folks covered that they considered the high priority areas for financial institutions. The first one's the accounting for and disclosure of digital assets, with cryptocurrency being the most popular. This was added to the FASB agenda in the second quarter of 2022. The objective is to improve the recognition, measurement, presentation, and disclosure of digital assets. Currently, certain crypto assets are accounted for under topic 350, the intangibles area, and are subject to impairment testing. So the next steps for the FASB is to perform the research and outreach to develop measurement alternatives. So obviously this particular topic is in the very initial stages for them. The next one was the accounting for and disclosure of software costs. This was also added to the agenda in the second quarter of 2022. So also in the initial stages. The objective for this one is to modernize the accounting for software costs and enhance transparency about the an entity's software costs. The scope includes recognition, measurement, presentation, and disclosure of costs for internally developed or acquired software. We're also exploring requiring a single capitalization model, updating existing models, and expensing all software costs. So obviously this one's in the very initial stages since they're exploring these different avenues. The next steps, of course, are for the FASB to perform research and outreach with stakeholders to develop potential paths for discussion at future board meetings. The third one, which Rob will go into a bit further as well, is accounting for financial instruments with environmental, social, and governance. This is a new research project. The objective is to research the ESG related transactions and disclosures in response to feedback received at the agenda consultation project that the FASB did. They've been researching financial instruments linked to sustainability initiatives, indices, or targets. So, if you have investments with certain bonds or funds that, have these sustainability initiatives, they're just researching how to disclose and present these. Most stakeholder questions relate to sustainability linked bonds or loans. There are also consideration of how ESG related provisions within the financial statement should be accounted for. And the next steps for the FASB is to continue research and bring to the FASB board for agenda discussion. So those 3 are in very initial stages, but they're the ones that they pointed out as high priorities. So next slide covers other projects that the FASB went over. First one being the accounting for investments in tax credit structures using the proportional amortization method, which is a mouthful. But this one, they're considering whether the proportional amortization method of accounting should be expanded to investments in tax credit structures beyond the low-income housing tax credit investments which they currently provide for. That one is, these are just their other projects. So I don't have any update other than this, as far as the timing is what I mean. The targeted improvements to income tax disclosures, their goal with this one is to improve the transparency and decision usefulness of income tax disclosures. The next one with the fair value measurement of equity securities subject to contractual sale restrictions, also a mouthful. This one was actually issued in June 2022. It's ASU 2022-03. It was issued to clarify the guidance in topic 820 when measuring the fair value of an equity security subject to contractual restrictions prohibiting the sale of the security. So again, this one was already issued in June of 2022. Next slide. This next one, disclosure of supplier finance program obligations. This one was completed in September of 2022, ASU 2022-04. It's a new subtopic of ASC 405-50, which is topic liabilities supplier finance programs. This accounting standard requires certain annual and interim disclosures for buyers involved in supplier finance programs, which are also referred to as reverse factoring, payables finance, or structured payables arrangements. This ASU intends to develop disclosure requirements that enhance transparency about these programs. The reference rate reform. The objective of this one is to monitor the global reference rate reform initiatives to identify areas of gap that may need to be amended in response to those initiatives. This reform is in response to concerns about structural risks of interbank offered rates, the IBORs, and particularly the risk of secession of LIBOR.
So if it does, can you pick up and just wing it through the slides?
So the next slide goes over the research agenda projects.
I'll just stop working.
Can you put next slide? It starts with accounting for and disclosure of intangible assets. So these are all their recent agenda projects. Next slide, please.
Yes, sorry, Rob is having some technical difficulty. That's
Gotcha.
why we could hear him in the background. So he was trying to get his internet corrected. So I was,
Okay, good.
I'm sorry.
No worries.
Technology's great. till it's not.
It's great until it's not, right?
Yeah.
And I'm just, the slides don't offer a ton. So if you'd like some more information, I can provide my notes on these items if anyone would like more detail on these projects. But these are just some of the recent agenda projects that the FASB are discussing. First one is accounting for and disclosure of intangible assets. Goal here would be to improve the accounting for and disclosure of intangibles, including internally developed intangibles in research and development. The next one regarding accounting for exchange traded commodities, they're just exploring accounting for and disclosure improvements. Next one, the accounting for government grants and invitation to comment. This research project was will solicit feedback on whether the requirements of the IAS 20, which is accounting for government grants and disclosure of government assistance, should be incorporated into GAAP. Next, for consolidation for business entities is a research project that's going to explore whether a single consolidation model could be developed for business entities. Financial key performance indicators for business entities. This research project will explore standardizing the definitions of financial key performance indicators and will be informed by the progress of the disaggregation income statement expenses project and consider the interactions with the regulatory framework. Hedge accounting phase 2. This research project will seek stakeholder feedback that could bring further alignment of hedge accounting with risk management activities beyond the targeted improvements made in the hedge accounting model with the phase 1. It could also consider changes to the definition of a derivative. The last one, which I think I don't have a ton of information on, but, you know, can definitely impact all entities. This research project will explore improvements to the statement of cash flows to provide additional decision useful information for investors and other allocators of capital. And those were the particular topics that were covered in the AICPA bank conference by the FASB folks that presented. So that's
Yeah,
it. So I think next we have a poll question before we move on to the next topic.
Yeah, we do. One thing I would say, Hillary, and if you recall, the reason that the FASB kind of changed their focus and went, were focused around cryptocurrency, really was in response. They did a survey, and the respondents, if I'm not mistaken, and don't quote me, but I believe that 80% of respondents mentioned crypto, and about over a third of them had cryptocurrency at rank number 1 in their responses. So as a consequence, that's how when cryptocurrency is at the top of the list, and that helped the FASB kind of prioritize what the end users were most of greatest concern to end users.
That's correct. Yeah, the 3 high priorities that we went over, the digital assets, the software costs, and the ESG areas were those did rank highest on their poll. They did.
So with that, we'll have a poll question. And they want to know if you have followed us on social media, and of course you have. You all are waiting daily for our Instagram posts, I'm sure. Hopefully you are. If you're not, please follow us. We'd love to have you join us. So with that, we'll move to tell you what we're going to do. Rob is presenting ESG, and he's having technical difficulties. So for now, we're going to skip ESG and move ahead to auditing accounting estimates and using the work of specialists. Heather Barber from our Birmingham office is with us and not experiencing technical difficulty, I don't think. And so Heather, with that, I'll turn it over to you.
Thank you, Doug. Yeah, hopefully not. All right, good morning, everybody. So next we're going to talk a little bit about accounting estimates and use of the management specialist. So what you've heard so far has more to do with accounting guidance or guidance to companies. This is going to focus on auditing and the auditor responsibilities. And then specifically, we're going to talk about accounting estimates and the use of specialists in our audits. So what we have up here on the slide are the 2 recent standards that provide guidance. The first one is the PCAOB AS 2501, auditing accounting estimates, including fair value estimates. It was adopted in December 2018. It was approved by the SEC in July 2019, and it was effective for audits of fiscal years ending on or after December 15, 2020. So since this one is already effective, we're going to focus more on the next one. We did list it to make sure that you can kind of take a look if you weren't aware of it. But the next one is SAS 143. This is auditing accounting estimates and related disclosures. It was issued in July of 2020. It's effective for audits of financial statements for periods ending on or after December 15, 2023. So it's coming up. And we're going to focus on this one since it's effective for next year end. And we are going to talk about, we're going to go through it briefly, but mainly because we want to make sure that you're aware of it and you're planning to update your procedures as needed. So I did want to bring up before we go into some of the details, I wanted to talk about what are some of the common financial institution estimates. So depreciation and useful life estimation, investments, the allowance for loan loss, and then also other real estate and repossessed assets, even though those are small, a smaller proportion on the books, hopefully, than the other 2 or 3. So the areas we're going to cover for estimates include identifying and assessing the risk. Next slide, please.
Okay, sorry.
That's okay.
Checking the chat, checking the Q&A, multitasking. Okay.
All right, so identifying and assessing risk, and this includes inherent and control risk. And the new standard does make clear that both of these are required to be evaluated and documented. And then we're going to talk about responding to the assessed risk of material misstatement in our further audit procedures. So how we're going to address the risk. And then there's a little bit on other takeaways from SAS 143 towards the end. Next slide. All right, so the first step that we're going to follow is identifying and assessing the risk. And to do this, we're going to need to understand the processes used to develop estimates. Now, so Doug and Chris both mentioned CECL, and I know that pretty much anybody that either works at a financial institution or audits financial institutions is aware of CECL and the impact in the allowance. But so keep it in mind for this discussion, because CECL is going to require additional audit procedures to identify and assess the risk, because all of our bank's processes are going to change, sometimes significantly, sometimes less significantly. So we do need to keep that in mind. So when we're understanding the processes used to develop estimates, we need to understand the methods used, including the model used. So going back to CECL, CECL is going to change the model for all of our banks. So you need to make sure you understand what model they're using and how they arrived at that decision and whether or not it's appropriate. Next, we need to look at the data and assumption used, including the source. We need to make sure we understand how management selected the data and assumptions to be used that are appropriate to the applicable accounting framework. And then we also need to make sure we understand management's concept of the estimation uncertainty and their selection of a point estimate. So when they're talking about data and assumptions used, do they understand how some of the data impacts the results, or do they understand how the assumptions impact the results? And then also use of third parties other than specialists. And then finally, we need to consider this when we're doing our engagement team brainstorming, including considering the possibility of fraud and management bias. So we need to talk about that. All right. So as I mentioned, we're going to separately assess inherent and control risk. And first, we obtained an understanding of the estimate, including how it was developed. Then we're going to use that information to assess the risk. So some of the key factors that are used in evaluating inherent risk is the degree to which the accounting estimate is subject to estimation uncertainty. So investments that are traded daily versus investments that are never traded, there's a big difference in the uncertainty in that estimate. The degree to which one or both of the following are affected by the complexity, subjectivity, or other risk factors. We need to look at the selection and application of the method, assumptions, and data in using the estimate. And we need to look at the selection of management's point estimate and the related disclosures. So again, for CECL, how complex is the model? Are they using different calculations for different types of loans? That's the kind of thing that you need to be looking at and make sure you understand when you're evaluating inherent risk. All right, next slide. So once we've assessed inherent risk, we need to evaluate control risk. And some of the considerations you just need to think about for control risk. If the auditor determines that a significant risk exists, they should identify controls that address that risk and evaluate whether such controls are designed and implemented to mitigate such risk. So when you're doing what we call control walkthroughs, if you have a significant risk, make sure that your understanding is actually addressing that significant risk. You need to consider whether we're going to place reliance on internal controls, whether we want to reduce control risk. If we're going to place reliance on controls, we need to make sure that our testing is responsive to the risks identified. And that is a common theme throughout, is making sure that what the procedures that we're performing are consistent with the risks. The control testing that we're performing is consistent with the risks. Next, we're going to talk about further audit procedures and actually testing the estimates. So this is how we're responding to the assessed risk. We need to select an approach for testing estimates, and further audit procedures should include at least one of the following. Testing the company's process used to develop the accounting estimate. That's the one that I use. I use that the most. Developing an independent expectation for comparison to the company's estimate. Evaluating audit evidence from events or transactions occurring after the measurement date related to the accounting estimate for comparison to the estimate. So we do need to look at subsequent events and how they impact our estimates. So for example, if there were material charge-offs that were year-end that the company didn't anticipate, how does that impact the estimate? All right, testing the company's process. So this is where at least I tend to spend a lot of time. And especially in a first-year implementation, I mean, once you understand the process, you need to test it. So testing the company's process includes evaluating the company's methods. And so when we're evaluating the methods, we've already obtained an understanding of the methods of how they develop that estimate. So we should be able to evaluate the method that they used. We need to look at whether the method's appropriate, if they've changed their methods. So we need to make sure if they've changed their method that it's not arbitrary. We also need to look for an indication of potential management bias. And that is also a theme in SAS 143 is taking a look at that. We need to look at the calculations. Are they mathematically accurate? So for CECL modeling, has the model been tested or validated? So even when you're using a third party, you do need to make sure that it's mathematically accurate. Next, we're going to identify the significant assumptions used by the company. And we need to look at management's rationale. So are those appropriate based on the financial reporting framework and the business that they're in? Is there a change in those assumptions? If there's a change in the assumptions, is it based on new circumstances or information? Is there any indication that that change in assumption is arbitrary? Or is there an indication of potential management bias? So those are some of the things you need to consider when you're looking at the significant assumptions. Next is testing the data used by the company. And so the first thing you need to consider is whether the data that they're using is appropriate for the estimate that you're looking at. We're also required to evaluate the relevance and reliability of information used. And we're required to evaluate whether the information is sufficiently precise and detailed for our purposes. And we're required to obtain evidence about the accuracy and completeness of that information. So you need to make sure that that information is accurate and complete before you can use the model. And so one more thing about testing is that how much testing we do is a function of risk. So testing historical loss rates and math for an Excel model would be different for a vendor model that's already gone through validation and has appropriate change controls. But you need to understand that before you can test it. Next, we need to evaluate the selection of the point estimate and development of the related disclosures about estimation uncertainty. So, in looking at that, our evaluation, it might include whether management understands the level of uncertainty, the degree of complexity, and whether they've appropriately selected a point estimate. So CECL models, again, they're going to be new. So we need to make sure that management understands it. And I keep talking about CECL because I know that that's coming up and it's going to be relevant, but this applies to any estimate. We need to make sure that management understands it and that we understand it when we're testing it. All right, next slide. So we could also develop an independent expectation. But what I want to say before we go through these is when we're developing an independent expectation, if you kind of go back and look at the other slides, the procedures are very similar to what you do in testing the process. So we're going to test and evaluate the methods, significant assumptions, and data in the same manner as when testing the company's process. We're going to determine that the range we come up with includes amounts supported by audit evidence and are reasonable. And we're going to evaluate the disclosures related to the estimation uncertainty. So in both of these, we're still looking at the disclosures and evaluation of the disclosures. Next slide, and I think we have a poll question.
Once again, are you still there? So
Are you
let us
still
know
there?
you're-
Yeah. I'm still here. I'm gonna be here for the next section of this too.
That's
Unless you
fine.
wanted to switch back to Rob. Is Rob online? You want me to switch back to him and come back, or you want me to keep going?
He thinks he's online, but we'll press on and let you continue
Okay.
on here,
Okay.
and then we'll come back to ESG after
Okay,
that.
that
But
sounds
that's
good.
poll question 5 of 8. And again, you have to answer 75% or 6 of the 8 in order to get CPE, and we want to make sure you all get your CPE. So with that, Heather, you can resume when you're ready.
Okay. All right, so this last slide is still related to 143. And it's just kind of other takeaways from SAS 143. So one of the things that's new is the concept of estimation uncertainty. And I talked about that in a couple of slides. We talked about management's understanding of estimation uncertainty to make sure that they know how those estimates are being impacted by everything that's going into it. There's information in here about the scalability of the standard. There's also some enhanced risk assessment guidance, and it's linking back, your procedures to the inherent and control risks. It also emphasizes that further audit procedures should respond to reasons for the assessed risk of material misstatement. And we also talked about that. So what you're going to be testing should address the specific issues and risks that you identified. Or if you're testing controls, you need to make sure that you're addressing the specific risks. It also addresses professional skepticism in estimates. And it also requires the auditor to evaluate whether estimates and related disclosures are reasonable in the context of the applicable reporting framework. So it mentions that several times throughout. I think that's it on SAS 143. All right, so next we're going to talk about using the work of management specialists. This is covered in Statement on Auditing Standard 144. There's several amendments that are included in here. It includes amendments to AUC sections 501, 540, 620, and those relate to the use of specialists and the use of pricing information obtained from external information sources. It was issued in June of 2021, and it's effective for audits of financial statements years ending on or after December 15, 2023, and it adapts PCAOB appendices on pricing sources. So this one is also going to be effective at the same time as SAS 143. So make sure you're implementing both of those. All right, so next slide.
Yeah. There we go.
All right. So when you're using the work of management specialists, we'll need to do several things. First, we're going to assess the competence, capability, and objectivity of management specialists and the specialist's relationship with the company. We're going to understand the work of the management specialist. And we're going to evaluate the appropriateness of the work of the specialist. And we're going to talk about those a little bit more next. All right, so assessing management specialist. So the first procedure is to assess the competence, capability, and objectivity of the specialists. And how do we do that? And there's several ways, and this does not include all of them. But several of them could be looking to see if they have a professional certification, license, or accreditation in their particular field. So for example, like appraisers will have a certification. Personal experience with the previous work of the specialist and the type of work performed. So if as auditors, we've worked with them before, we're familiar with their work, we know that they are capable and competent. That's evidence there. And also through discussions with the specialists and through other sources. So if we're having discussions with the specialist, we can kind of gauge their competence and their capability. The last part is their objectivity. And to evaluate that, part of what we need to do is look at their relationship with company. And then there's some other factors to look at to evaluate their objectivity. And those are in the standard. All right, so next, we're going to gain an understanding of the work of the specialist. So in our risk assessment, we've already obtained an understanding of the estimate and how complex it is. Here, we're required to obtain an understanding of the specialist's work. Understanding the work of the specialist does include understanding their relevant field of expertise. This may be obtained in conjunction with determining whether the auditor has the expertise to evaluate the work of management specialist or whether an auditor specialist is needed. So we're going to be relying on the work and we're going to be evaluating their judgments. So we need to determine whether we're actually qualified to do this or whether we need our own auditor specialist is what this is talking about. Next slide. All right, so when we're evaluating the work of the specialist, this is where the judgments come into play. We need to evaluate the appropriateness of the specialist's methods, their significant assumptions, and the data, including relevance and reliability. So if you'll go back, if you look back at the other slides, this again is pretty similar to when the estimate's calculated by the company. We're looking at similar things. But this is why we need to make sure that we have the expertise needed, or we have an auditor specialist to make sure that we can appropriately evaluate all of this. Also, I wanted to point out that when we're talking about evaluating the appropriateness of the data, that does include testing the data used. Basically the same as when the client's performing the estimate, you need to make sure that that data is accurate and complete. Then you also need to evaluate the relevance and reasonableness of conclusions, consistency with other audit evidence, and the financial statement disclosures. All right, next slide. All right, so when you're planning procedures related to evaluating the work of the specialist, you need to consider the nature, timing, and extent of further audit procedures. So these are impacted by the risk of material misstatement, the significance of the specialist's work to the auditor's conclusion, how important or critical is that estimate, and the ability of the company to significantly affect the specialist's judgments and other factors. So I want to talk about this ability of the company to significantly affect the specialist's judgments. This kind of goes back to the objectivity. You just need to be aware as an auditor that there's always going to be a threat to objectivity created by being a specialist who is also an employee of the company. That doesn't mean that there can't be controls to mitigate it. That doesn't mean that you can't use an internal specialist, but you do need to be aware of it and make sure that we're appropriately addressing that. Next slide, please. All right, and then this last piece of information, when we're evaluating the work of the specialist, we need to consider more audit evidence is needed as the significance of the work of the specialist increases, or as the ability of management to affect the specialist's judgment increases, or as the specialist's competence, capabilities, and objectivity decrease. So if we have a risk related to that employee, because management can impact their results, we need to appropriately address that. We need to make sure we're documenting how we've addressed that. A consistent theme throughout is identifying risks and developing audit procedures to appropriately address those risks. So with regard to specialists, we need to make sure if there's something that's too complex for us, we've obtained an auditor specialist. If the specialist is new to the industry, we need to make sure that we consider whether we need to do additional procedures related to that. And if there's an objectivity issue, we need to look at that and see if we need to do additional audit procedures related to that. So making sure that we're appropriately addressing the risks. And that's it. I think we have a poll question next.
It's we do have a poll question, and one thing I would add, these standards are very similar to what was put in place via audit standards by the PCAOB, and we've adopted those on our public company bank audits. And I would say if you're an auditor or auditee, I would expect more clarity in these areas coming from your auditors. And if you're an auditor, you're probably going to need to do more. We have seen it be a little bit more robust exercise as a result of adopting these similar standards in the public company arena. And with that,
Yeah, and that's a good point, Doug. Sometimes clients ask us, why we're doing these additional procedures. And for this one, this is specifically why is these two new standards. So
yeah, no, it's those are straight out of those slides are straight out of the standards. So that's what we got to do. So thank you, Heather.
thanks.
All righty. So I'm gonna backtrack now. Rob DeMombrin, who heads up our Nashville practice, is having some difficulty, and we are going to. Sorry, you have to look at me scroll through the slides, but anyway, Rob thinks he's back online, and he's our ESG person. So, Rob, are you're not going to leave me to do ESG? You good?
Well, I'm good. Yeah, I'm good, Doug. I got a lot of text from some of the presenters that were worried that I was going to drop off because they were not wanting to cover this. So I'm here. Hopefully you can hear me well, and I'm sorry for that. I was just you heard me earlier while Hillary was talking, but and I was just so excited to talk about you at ESG that I wanted to get a head start. But I did in an A&A session like this, probably some may be wondering, why are we covering this? What's the point of it? It's definitely a hot topic. You can't open up a publication these days without seeing something related to ESG. And I know represented on this webinar, there's a vast array of companies and sizes, and so you may think, why does it apply to me? And it does, and in a lot of different ways. So really today, what I want to cover, as I have just a few minutes to talk about it, and not enough to cover it and give it the credit it deserves or needs, I just want to really go over a general overview of what ESG is. Environmental, social, and governance is what it stands for, but really what those represent. We want to talk about, what significant proposals are out there right now related to ESG matters. We want to talk about how some ESG matters too can affect current accounting and auditing right now. So, as you know, it's a hot topic. Mentioned that earlier, that it is a topic that you can't open up a publication without seeing anything about it. And studies have shown too that more customers and employees, they're changing loyalties, and they're choosing to do business with organizations that their strategies and policies align with ESG responsibility. So even though you might not think it affects you, it really does in some way. Maybe not necessarily the reporting aspect of it, but it does affect your institution. So first and foremost, what we want to do is start off by really looking at each of the components, and then looking at some topics underneath each of those components and what they represent. And then what we'll do after that is after going through a high level on that, we'll drop back and look at some current proposals that are out there from the banking regulators, and also some SEC, and then some other guidance and resources that are available for you to look at and use as you run your business. So let's start off with what's on the screen here with environmental. So environmental, as you can see from what we have on the slide, is that it's how does the business operations impact the environment, and then also in reverse, how does the environment affect our business? So another way to say that is, how is an entity exposed to, and how does it manage risk and opportunities related to the environment? So how does that work? So some topics underneath environmental that we think of when we think of environmental, or maybe we don't, is climate change, the greenhouse gas emissions, net zero strategies. You see all that in any paper you read, any publication you read, the debate and conversation surrounding that. Also pollution, deforestation, energy management, like energy efficient buildings, raw material servicing, renewable energy, waste and water management. So specifically, those are some of the topics that come up under environmental that we have to deal with. Really, those things are grouped into two types of risk. And those risks being what we call physical risk and transition risk. With the physical risk meaning it is related to more of an acute event. So a specific weather event like change in weather patterns, severe weather, tornadoes, flood, drought, wildfire, things that happen that affect our business, and we have to address those risks. There's also transition risk, where we have to deal with changes in technology related to environmental factors. We have to change, there's a changing, obviously, regulatory environment right now, shifts in policy. And one of the most common ones, right now that's going on, is thinking through shifting from an economy that relies on fossil fuels to one that is looking for other sources of alternative sources of which to supplement or use over those fossil fuels. So there's a lot of transition going on, but those physical risk and transitional risk are things to think about as we think about environmental. So then on the next slide, we get into the social aspect, which from a definition that we have up here, is how the operations of our business affect the community and the people that we deal with in our communities and then our employees. It's really the entity's values and their business relationships. So how are we handling those matters? Examples of that would be community relations, diversity, equity, and inclusion, employee health and safety, human capital development, labor management, things of that nature, human rights due diligence that's on there, compensation. So things that factor into how we are socially responsible as a company are the matters in the social component. So on the next slide, we have the governance aspect of this, which we've dealt with in our entities for a while, but it's really how a company behaves and governs. So it's our entity level type controls when we're talking about ICFR. It's a system of rules and practices and processes by which an entity is directed and controlled. Mostly examples of that would be anti-bribery and corruption, anti-fraud policies, business ethics, corporate resiliency, diversity, leadership, executive comp, tax transparency, and ownership structure. So this is one that we've dealt with for a while in different ways, and that we do manage those risks through various controls. There's some that are new, like we mentioned one, board diversity, that's been a hot topic, and then diversity and leadership. But some of these we've factored in for ages, and but coming to the forefront now. And I'd say that's been the case in all of these, but they've definitely been brought to the forefront currently with shifts in policy and things of that nature. So really where I want to go now is talk about some of the proposals that are currently out there. And some of this may not apply to you, some of it may, but what we do know, and we have seen historically happen, is that as regulation and disclosure requirements start off at a really high level for the bigger companies, there is obviously trickle down that occurs, and it ends up affecting, fortunately or unfortunately, smaller companies as well. So while this may not impact you directly right now, I think it is something to keep an eye on and consider going forward to see how this plays out over time and affects our smaller entities as well. So the first thing I'll mention is the SEC in March of 2022, they issued a proposed rule, and it was the name of it's on the screen: Enhancement and Standardization of Climate-Related Disclosures for Investors. And comment period for this was extended. It closed in June of 2022. It's not final yet. Some of the implementation dates you'll see on that screen are based on as if this had been final as of December 31, 2022. It is not final, it has not been finalized. Still a lot of debate going on. Even as recently as this past Friday, a couple of House Republicans introduced a bill that would limit the SEC's ability to establish new policies and or additional disclosure requirements on companies, specifically mentioning this climate-related disclosures. It somewhat mirrors a bill from the Senate, a proposed bill that was introduced as well. So there's a lot of debate going on still about what to do with this, but I bring it to your attention because there's already, if you look at public disclosures, there's publicly held companies. And again, this relates to publicly held companies, registrants. If you look at some of the filings, even our financial institutions, you'll see there are discussions and risk factors in other areas in Form 10Q about ESG matters. And so what this is doing is it's a proposed disclosure, or it's to formalize or make that disclosure more uniform. Currently, there are disclosures out there and they're using other frameworks that are pretty broadly accepted. So this really makes that uniform and makes it required in periodic filings. So there would be a new regulation SK subpart that would be added, part 1500, that would be added that has requirements for disclosures and metrics. And you can see on the screen, the highlights of this are that it's climate-related risk and their actual or likely material impacts on the registrant's business and strategy. Outlook would be disclosed. These are all disclosures. Registrant's governance and climate-related risk and relevant risk management processes, greenhouse gas emission, for which accelerated and large accelerated filers with respect to certain emissions would be subject to assurance. There would be a phase-in factor on that. And then certain climate-related financial statement metrics and related disclosures in a note to the audited financial statements, and also information about climate-related targets and goals and transition plans. So there's a lot of detail. It's a huge document, huge proposed rule. There's a lot of good summary documents out there you can look at, and you can see the implementation dates. These are based on size or filing type, filer type. It's also based on the limited assurance, what's placed on that. So there's the implementation dates run from 2023 to 2027. And so that is something to be on the lookout for and see what happens with that. So I'm going to move on now to what the banking regulators are doing. So the banking regulators have been active as well. And again, as recently as last Friday, there have been some proposed principles put out there for risk management related to climate. And the first that came out was from the OCC back in December of 2021. They put out a plan. So the FDIC in March of 2022, and the Federal Reserve just this past Friday put out a plan, principles for climate-related financial risk management for large banks. So that large banks or large institutions is the key word right now, because right now these proposals, which the FDIC and OCC, the comment periods are passed, Federal Reserve is still open, but this is for financial institutions with consolidated total assets over 100 billion. So it is for larger banks. But again, I think it's important to mention this because we do see trickle down. And even as the FDIC released this guidance or these principles, proposed principles back in March of 2022, the acting chairman at that time said that all financial institutions, regardless of size, complexity, or business model, are subject to climate-related financial risk. So there may be questions during exams. There may be things that you're asked. So it's something that's on the table. Really, what these principles are intended to do, you can see on the screen, is that it's to support the bank's efforts to focus on key aspects of financial risk management for climate-related activities, and then provide a high-level framework for financial risk management of those activities as well, consistent with existing rules and guidance. So with that being said, again, I can't stress enough just the importance of keeping up with all of this, because it is ever changing and things are coming out all over the place. It's almost like I didn't even want to say that the SEC rule wasn't final, because it could be by now, but I know it's not, because there's been some pushback on that. There's a couple other things that I wanted to mention that are not in the slides that I wanted to bring up, since we do have an A&A audience present. Things that are out there from the AICPA and FASB that they've done over the past year and a half, that I thought would be interesting if you want to go look at some of this stuff. Back in March of 2021, the FASB released a staff educational paper. It's called a FASB ESG paper, where it's talking about the intersection of ESG matters with current financial accounting. So really what it does is it highlights the connection between ESG matters and then their direct and indirect effect on the financial statements. So that's out there. It also illustrates how an entity may consider the effect of material ESG matters with existing accounting standards and current regulatory environment. So it goes through some examples of what effects maybe climate-related issues may create to the financial statements and how those are presented and the accounting that relates to them. Specifically, when you think about acute weather events, you think about tornadoes, which we've had those in some of our markets for sure, other matters related to global warming, but how does that affect impairment calculations for goodwill and certain intangibles? How does that affect useful lives as we maybe equipment becomes obsolete or is phasing out? Also other types of intangible assets that are amortized, inventory, environmental obligations, loss contingency. So it addresses those items and how that could have an effect on ESG matters that are presented to your entity. The last thing I want to mention before I get off is the AICPA in 2021, late 2021, issued a practice aid. Title of that is Consideration of ESG related matters in an audit of the financial statements. And really the focus of that practice aid was on climate related matters. So ESG, not so much the full ESG spectrum, but really focused on climate related matters. And the purpose of the practice aid was to help auditors in assessing management's policies and procedures as they related to climate related matters, and also how the auditor should address, consider and evaluate management's responses to those matters as they're conducting an audit of the financial statements in accordance with generally accepted auditing standards. Also in that practice aid, there's a table in the back that shows how certain audit standards correlate to these climate related matters, and they give examples of how they may apply. So it's interesting just to see how that possibly could work. Again, we all have seen that happen in at least weather events in our clients and in our companies. So it's good information to keep in mind. So I guess in closing, what I'd say is, again, remember, this applies not only to our direct operations at the bank, as we're considering these effects to our financial institution, we also have to think about our customer base. We have to think about our borrowers and depositors and the effect of some of this policy on them as well, and how that affects our loan portfolio. We have to think about the investments we make and how these policies can affect those investments. And so also just staying current on what's going on in this area. I know it's a charged area, it's a hot topic, but it's something to at least keep an eye on to see how these things develop and where the regulatory burden or guidance leads, and then also how the accounting and reporting also follows along. So that's all I have at this time. I think we have a poll question following this.
We do, and we'll get to the poll question. Thank you, Rob. I think the good job. It's obviously a hot topic. If one thing we'll do, and as you all are answering that poll question, I think it's a good time to peel off and and answer some questions. I'm gonna go back to one from my neighbor, Terry Knoll. And I think there's also one in there from Paul Thompson for Heather. But Rob, there's 2 or 3 in there on ESG. I didn't want to put you on the spot. If you want to take a look at those, we'll answer these verbally and then let you gather some thoughts on the ones that were posed while you were speaking. So we have a question of any thoughts on how the FTX collapse will affect FASB audits, et cetera. And I'm sure everybody's familiar with the FTX collapse. The answer is I'm not sure how it will affect FASB or audits, but I think I'll tell you what we desperately need right now in my mind is we need a regulatory framework that actually addresses digital assets in a meaningful way. And so the White House, the executive branch has an initiative, and they've done a couple of things. There's been some discussion in the legislative branch. The banking regulators have put out guidance, but honestly, that guidance has not been very specific. It's basically been, we're not telling you not to be in the digital asset space, but and if you're going to be there, you got to ask our permission. But whatever you do it in a safe and sound manner. But it's very general. So what we need more than we need the FASB to come up with some accounting guidance is for our executive, legislative, and our regulatory agencies to come up with some regulatory framework, which might then impact the accounting aspects of this stuff, and hopefully that regulatory guidance would prevent similar things from the FTX collapse or these cryptocurrencies that are supposed to correlate and have relationships that are constant, that have actually not had those relationships and resulted in massive, losses for those holding those cryptocurrencies. So that's the first question. The second question that we have, and Heather, I think you've seen this one. How does one determine if specialists' competence and capabilities decrease?
Okay, so I think this is about the very last slide that I had, and I'm going to go back and read through the slide again and explain it as I go, because it's not actually about a change in the competence and capabilities. Yeah, the very last slide.
I'll go too far. Okay, here we go. That's it.
Okay, so basically, let me go through this slide and I'll break it down. So more audit evidence is needed as the significance of the work of the specialist increases. So on like a scale, the more significant it is, the more audit evidence you need. The next piece is, or as the ability of management to affect the specialist judgment increases. And that doesn't mean that it changes from year to year, although it could. That means on a scale, how much can management affect the specialist judgment? And as it is increased on the scale, we need more audit work. And then the last piece is as the specialist competence, capabilities, and objectivity decrease. So if they have a lower competence level on a scale, or if their capabilities are lower on a scale, that impacts our audit procedures. We need more audit procedures if they have a lower competence level. So it's not necessarily about their competence level changing, which I think is what that question is about. And I'll write back if that doesn't answer your question.
Okay, thank you, Heather. There's one
Thanks.
question in there I'm certain I can answer, and that is this a 1 hour or 2 hour course? And the answer, it's a 2 hour CPE course, which means it's 100 minutes. 50 minutes equals an hour in CPA world under NASBA. So we have more time allotted than that as needed, but at a minimum, we need to have 100 minutes so you all can get the appropriate level of CPE. But you also have to answer 6 of the 8 poll questions in order to get the 2 hours of CPE. So the remaining 3 questions are ESG. So and Rob, not put you on the spot, answer them however you like and in what order. And I know there's others on here. I know Chris has had some involvement in ESG, so the answer might come from a couple of different places.
Absolutely. So I thought my internet might be going out again, and you all would answer these questions, but it's still going. So I'll just start with the first one that was asked about what will the new Congress do with ESG, states pulling funds, companies spending on ESG. I think right now with the new Congress, I think we'll see what happens. I think limiting some of the regulation obviously is what's starting. It started back in the middle of 2022, but with these proposed this bill that was introduced last Friday, I think there's definitely going to be pushback. I wish I knew the answer to that, but I think you just need to hold tight and see what happens, because there are things every day coming out about that. I know that's a vague answer, but it's about the best answer I have right now. I'll also go to one that was asked about, is there any view as regards when or if ESG disclosures would be required for non-public, for-profit or non-profit entities? As far as I'm aware, from similar to what we've seen with the SEC, those type of disclosures, I have not heard anything yet of that coming on board. You know, as I mentioned, I think it'd be good to look at that FASB ESG paper that's out there that shows some of the potential disclosure that could exist, specifically related to climate, but it's more that physical risk from tornadoes and weather related events, and see how that can affect us now. But as it relates more to climate change or the greenhouse gas emissions and the net zero strategies, not seeing that yet. But again, I think we just have to see when that happens, when and if. And then the last question that was asked was, as a CPA firm, as entities, what do we need to do with ESG programs or compliance? I think my answer to that would be, we're no different than any other entity. And so what we need to do is be looking at our I won't say compliance, but maybe risk assessing that to see what touches us, what our plans are in dealing with that, how we have, and be ready to move forward with that.
Well, I think, Rob, it's like you've said in a couple of different ways. I mean, a lot of this stuff is in process. A lot of it is being directed at the largest companies, and likely if there's something directed at the CPA world, it'll probably start at the Big Four. But we expect a trickle down or some type of there's going to be expectations of community banks. There's going to be expectations of regional CPA firms. We can expect that going forward. So we all need to be educating ourselves and get ready for when the time comes that there's actual requirements out there.
Hey, Doug, one thing to point out is there's some various industry letters on ESG and potential principles around those. I know there's one from June the 23rd, and they have some really good points about things for financial institutions to consider as part of that. So I just wanted to point out the various industry letters within the last year on ESG.
Okay, thank you, Chris.
Yeah.
So with that brings us to our final section. We're at 99 minutes, so we're almost at the 100 minutes. And we have asked 7 of our 8 poll questions, and you have to answer 6. So just being transparent about where we are in this. And at this moment, we've addressed every question in the Q&A. So feel free to continue to ask. We'd be more than happy to address them. Okay, so we want to talk about what the PCAOB has been up to and what the SEC has been up to. And I think the way I would preface this is the participants on this call, if you're an auditor, you may or may not do public company audits. If you're an SEC registrant, you may or may not be. You're likely, there's certainly a lot more institutions on here that are not SEC registrants than are. But similar to the discussion about ESG, there, and we know this in our profession, if something's out there from a PCAOB perspective, it's going to be in gas, and it's going to be a shorter window of time than expected, just as the information that Heather covered is now going to be applicable to private company audits. It was applicable to public company audits, 2-3 years ago. So I lose track of time, but nonetheless, this information is relevant, and it's also relevant in the SEC stuff if you're talking independence, and we will. If you are subject to fiducia, so if your bank's over $500 million in assets, if you're 500 million or more, then you're subject to the SEC. Your auditor is subject to the SEC independence rules. So with that, I'll get in here. So from a standard setting and research perspective, here are the short-term standard setting projects that on the PCAOB's agenda. In fact, this quality control one just came out last week, I believe. Quality control, non-compliance with laws and regs, attestation standards update, going concern, and confirmations. Those are the 5 short-term standard setting projects. And again, I think the quality control one was issued last week, and I have not looked at it, but I believe it's out there. Midterm standard setting from a PCAOB perspective, substantive analytical procedures. That'll be interesting. Fraud. And we'll see where Dr. Paul Munner, who is the head of the SEC accounting, he's the head of the accounting department, if you will, for the SEC. I'm losing my thought on his actual title, but Dr. Munner has spoken to fraud, so we'll address that. Interim ethics and independence standards and interim standards. Those are midterm standard setting projects at the PCAOB, and then research projects, which means they're in a earlier phase. Data and technology and audit evidence. So here's some feedback from PCAOB inspection activities in 2022, which I thought was interesting, particularly if you're a bank or other financial institutions. So approximately 20% of inspections in 2022 included financial institutions. When they're, and this is just so everybody understands, this is when the PCAOB is inspecting audit work of firms like ours. 20% of the engagements they selected were financial institutions, and I can say the last time we went through it, one of our banks was selected. They include risk-based and non-traditional focus areas. What that really means is they're focusing on the risk areas, but they will also select a random area to examine. They don't look at the whole engagement. They pick a couple of risk areas and one random area to examine for compliance with PCAOB standards. Commonly selected areas for banks include loans and the allowance, and investments, including derivatives. And I can say firsthand that is true. Those are the commonly selected areas. They continue to identify recurring deficiencies, but amongst the larger firms, and I'm going to presume larger firms to be top 10, top 15, maybe. There's fewer. The trend is towards fewer deficiencies in 2022. Here are some of the common audit deficiencies that are found related to auditing the ACL, which is the allowance for credit losses, the allowance for loan losses, but it's ACL under CECL. Common audit deficiencies were noted as follows: sufficiently testing significant inputs and assumptions, including failures to evaluate evidence that supported changes or lack of changes. So, hey, what are the inputs? Did you test them? Did you identify and evaluate management significant assumptions? If this sounds familiar, this is exactly what Heather was just talking about. And it includes the failure to evaluate changes in those, particularly the assumptions, and then, or what if there wasn't a change? Should there have been a change, and how you evaluate that? Testing the accuracy and completeness of the information used to develop the reserve. In our inspection process, which has been about 1.5 years ago now, and you can find our inspection results out on the PCAOB website. If they said accuracy and completeness of the information once, they said it 1,000 times on every area. So it's a very, very much important, and it's important if you're not just if you're an auditor, but also if you're the auditee, because you've got to have a basis for why your information is complete and accurate for us to be able to audit it for completeness and accuracy. Perform procedures to identify significant assumptions or evaluate, and this is the failure to perform procedures to identify significant assumptions or evaluate how the issuer analyzed the sensitivity of those assumptions. The issuer is the bank. So the issuer is the financial institution. So the audit firm failed to perform procedures to identify significant assumptions or to evaluate how the issuer analyzed them and did a sensitivity analysis. So the issuer is supposed to do one of those, and we're supposed to audit it. This relates to auditing ICFR, also known as internal controls over financial reporting. These are some common audit deficiencies noted in the inspection process. The failure to test the design and operating effectiveness of controls that include a review element. So it's a review control, and that's the not adequately evaluating the design of the control or testing operating effectiveness of review controls. And also the failure to identify and select controls for testing that address risk of material misstatement. So the inference there would be there's controls that are key controls from the PCAOB's perspective that are relevant controls for which that directly address risk of material misstatement that were not identified and selected for testing by the audit firm. And then lastly, the failure to test controls over the accuracy and completeness of issuer prepared data or reports used in the operation of controls. Again, I mean, that's an ongoing theme. So accuracy and completeness of data, again, the bank or the institution has to have a basis for how their information is accurate and complete for the auditor to then audit that basis and the accuracy and completeness of the data. I thought this was interesting, particularly if you're an auditor, but and again, there'll be a trickle down typically. So specifically looking at the confirmation process, and many audit firms use third-party service providers to send and receive electronic audit confirms. And, there's a reliance being placed there. The use of SOC 1 reports to evaluate controls at those service providers, do the firms do that? Just like, does the bank conduct, appropriate due diligence on relevant third parties? Are we as firms doing that when we're using these places? And we do use them both in our public and private company practice. Also, there's some focus around audit deficiencies identified in the confirmation process and looking at that. And also, there's a spotlight document related to the use of service providers in the confirmation process that's available on the PCAOB website. So confirmations is a focal point for the PCAOB. So we would expect some type of guidance coming out. And it's something we need to go ahead and proactively address and make sure that we're doing appropriate due diligence when we're relying on any third party for any audit procedure. Okay, so these are some kind of activities, these are the activities of the acting chief accountant, and that is Dr. Paul Munner, whom I was trying to articulate his title previously. So he's the acting chief accountant at the SEC, and here's some things that he has made specific public statements on, which is a precursor for what the focus is going to be of the SEC, but also of the PCAOB. So one area is focused on high quality independent audits and the oversight role of the audit committee. There is a focus on independence. And again, the reason that's important is because if anything changes in the SEC independence rules as it relates to audit firms, then that is applicable if you're a fiduciary bank and over $500 million in assets. The importance of high quality financial reporting in a complex environment, the importance of FASB standard setting process and investors, analyzing materiality of errors from the lens of a reasonable investor. That's important. That materiality in our audits is important. The PCAOB does look at that in their inspection process, and here the acting chief accountant is reiterating some of that. Kind of an area of focus for his activities this year. I mentioned independence. So he on June the 8th, he went into the critical importance of the general standard of auditor independence. So not the interpretive stuff or whatever, but just the baseline general standard, and also the culture, the ethical culture that are in in the accounting profession. And he emphasized Rule 201 with Reg SX. Office of Chief Accountant's approach to independence consultations. Apparently, they're getting a lot of independence consultations, and they wanted to convey publicly their approach to those. Recurring themes from those consultations, and the importance of accounting firms fostering an ethical culture concerning auditor independence. So significant focus on auditor independence, which usually means there's going to be some additional requirements or guidance, and we'll be looking for that. Again, on 829, he addressed auditor independence and ethical responsibilities and critical points to consider when contemplating audit firm restructuring. Of course, the Big Four have all, couldn't tell you for sure if they've actually executed on their restructurings, but they are contemplating them, splitting off consulting from the accounting firm. And really what this was about was saying, if you're going to split it up, you really have to split it up. It can't be, two divisions under common control. You have to have a separate entity with a separate governance structure over your accounting firm and a separate one over your over the consulting piece. And also in this mix, there's a lot of private equity investment taking place in firms outside the Big Four, and that has independence implications. So there's been some discussion in and around that. 1011, Dr. Munner referenced the auditor's responsibility for fraud detection and gave a presentation on that and provided some public statement. If you remember going through the PCAOB projects, fraud is one of those. So I would fully expect for there to be some activity around the requirements, audit requirements to detect fraud for auditors, for public companies. The SEC issued SAB number 121. So going back to some of the discussion about digital assets and what the FASB is doing, in March of this year, the SEC got in front of it, and they issued some guidance and that around safeguarding crypto assets. So it provided accounting and disclosure guidance for entities involved with safeguarding crypto assets on behalf of others, which theoretically would apply to bank, not theoretically, practically would apply to banks and other fintech companies that might be safeguarding crypto assets that are also public companies. The end result was the reporting entity must record a liability for its obligation to safeguard crypto assets, which is initially and subsequently measured at the fair value of the protected crypto asset. A corresponding asset would be recorded. So what they're saying is if you provide safeguarding services for crypto assets or others, that you have to record that liability at fair value and have a corresponding asset for the same amount on your balance sheet. Additionally, there were some disclosure requirements, and I'll go back. This was for the first, it was issued in March, but it's applicable for the first interim or annual reporting period ending after June 15, 2022. So that would have been 9/30 for calendar year. That would have been for the third quarter Q, and then for the year-end K. So that would be applicable now. The disclosures requirement is you have to disclose the nature and amount of crypto assets being held, the accounting policies for safeguarding activities, the basis for how you came up with fair value, and any other risk and uncertainties arising from those safeguarding activities. And with that, we come to our last poll question. Number 8 of 8. We're wrapping up. I'm going to check the Q&A, see what we have. We're at 12:55, so we have 5 minutes on our time. So from a question standpoint, we have 2 questions in the Q&A. And if you've answered the questions and you need to run, that's, whatever you need to do. Got 2 questions left. One, I'll address, it relates to SAB 121 crypto accounting. When and how would the values of the asset and liability diverge? Might be the wrong answer, but I'm unaware of why they would. If you have to record the liability at fair value and have a corresponding asset at fair value, I'm unaware of how they would diverge. I can't think of a reason they would. Again, we're only talking about when someone is holding crypto assets, safeguarding them on behalf of someone else. So I don't know why the liability and asset wouldn't equal. The other question in here, and Heather, I don't know if you've read this one, so I don't want to put you on the spot, but I guess I'm about to. The question is, can you define specialists a bit more? If you already answered that question or it is in the slide, please direct me to it. Thank you, Terry.
Hey, Doug.
Hey.
I didn't see that question, so hang on, let me take a look. What is it? Yeah, I actually don't know that I see a definition in here. Let me see.
Well, really, if it's a critical area, and really, I think it depends on the activity, and I think there's some judgment in that. I don't think I've ever seen it clearly defined as to here's the 3 boxes you check, but I think if it's in an area that requires third-party expertise, number one, if you require expertise, they're probably a specialist. And if it's a critical area, be it from a materiality perspective, is it an area of estimate? Is it a area of sensitivity? I think in those areas, if you're requiring third parties to help you account for or run a model or whatever, I honestly those in our world, and we work with primarily community banks, and generally they're going to be somewhere between $500 million and $5 billion in assets. In that world, the specialists are pretty clear, both from a management perspective and obviously we know when we need an auditor specialist, although that wasn't the specific focus of the guidance. But maybe that was a little bit of a ramble, but I think it's I guess there could be areas in which you would have to deliberate and determine whether or not you consider someone actually a specialist.
Well, and so I did find in here, Doug, where it talks about the auditor specialist. It's not management specialist, but it's basically when you don't possess the skills or knowledge necessary when the matter involves a field other than accounting or auditing. For example, valuation skills, you may need to use, it talks about auditor specialist. I would think it would be similar.
Yeah. Well, in one debate I think of with 2 minutes left is we've talked internally about if you have somebody doing if you have bank-owned life insurance, and it's usually a big number and it's usually material, but the bank might have somebody doing the accounting for that for them. But, are they really a specialist, or is it just out of convenience for the institution,
Right.
to have somebody do that accounting? Because it's not highly technical. The CSV is the CSV kind of thing. So anyway. Okay, well, I think we're done. I thank you to everyone who took time out of your day to join us today. We appreciate your time. We hope that you felt like it was a good investment of your time today. And thank you to our presenters today. Y'all did a great job, and thanks a lot, and talk to you all later.